My first guest says the biggest support for the market will come from Mag 7 names this year, not from the Fed, unless the labor market takes a dive. Joining me now is Barbara Doran, CEO and Chief Investment Officer at BD8 Capital Partners. Barb, it's going to fall to the big guys again?
I think so, John. I mean, we have seen like the last 4 days or 3 days of the 25 trading year, a lot of them sold off. And in fact, they haven't done much for a while, but their PEs are now cheaper than they were at the beginning of 25. And you're seeing what's happening today. They're all popping up, NVIDIA, because these continue to have solid earnings growth and revenue stories. And so anytime they will get ahead of themselves periodically, people will take profits, try to rotate into something that's lagged. But investors always come back to this because the earnings growth and revenue growth for the foreseeable future is very real. So I think, and also if you look at the percentage composition in the S&P 500, it's 30% of these top 7 names. It's in terms of profits, it's 40+%. So they at least have to stay, copacetic. They don't need big increases in their stock, in their earnings and stocks to maintain their weight here. And that should be for keeping the S&P 500 performance good for 26.
Well, they have to for the S&P's sake, but is this Jenga? Are we top heavy with these names? I mean, the valuations are so high and there's so much expectation for smooth results as this AI capital build out continues. Things hardly ever move in a steady upward trajectory.
No, they don't. And particularly for growth names, you always have periodic frights. And we've certainly seen that in spades this past year, or in 25 with, DeepSeek. There'll be constant, information and innovation coming out. And we're seeing that practically daily. But again, it's like I always look back at Amazon when they kept reinvesting in their business. They didn't make money for years and investors would periodically throw their hands up. Or Meta. Meta sold off again, on a big increase in spending, which happened a couple of years ago. And of course, that was a great buying opportunity because they do have a gift for turning that spending into productivity and increases in their business. So I think that you have to live with the volatility and in general, where the market is, the PE is pretty high, but so I think that, but earnings will continue to come up. And that's where I think you see things will hold up in 26.
Domestic indices pretty heavily dependent on these big stocks, still up more than 16% in 2025. But a lot of international markets did even better. They're not dependent on the same stocks. How much stock do you put overseas?
Well, I think diversification here is a good thing because international, as you said, both developed markets and certain emerging markets outperformed, our markets, which did pretty well. So I think you can diversify into, you look at Europe, the fiscal stimulus from defense spending, and that's not something that's over in 6 to 9 months. That's going to continue to provide support as they continue to spend there. And you look at the emerging markets, the dollar was down just under 10% in this last year. And the question is, do you think it stabilizes here? Does it go down further? It really depended to a great extent on interest rates. But you saw like China and the U.S., we seem to have stabilized in our relationship there. We'll see what the Taiwan will be of interest this year to see what happens there. But other emerging markets, you've got better earnings growth than we do. There seems to be some stability. And plus, they're diversifying. Other countries are trying to diversify away from us. And you're seeing China do that somewhat successfully in their trades.